All right, we're back. Today I want to talk to you about this thing called carried interest. You may not know what that term is, and that's why I'm doing this video. You may have seen a lot of talk about carried interest in the news lately, especially when the Inflation Reduction Act was being negotiated and passed, because that was a provision in there that they were going to expand and use to create more tax revenue potentially. Of course, it got taken out last minute, but the reason I want to cover it is because it comes up every couple of years again. It was also in the Build Back Better Act for a little bit. They tried to get something in there back when the Tax Cuts and Jobs Act passed. I mean, this has just been going on for decades, and they actually did get a little bit in there back in 2017, because what essentially happened is that you could have long-term capital gains. So given that you're probably going to continue hearing about it, let's get into what this actually means. A carried interest is typically, or at least one of the attacks on it, is that it's mostly used by private equity firms and hedge funds, because what they'll do is they'll raise a bunch of equity and they'll invest it. In order to manage the investment, they'll typically charge a fee based on the assets under management, or an AUM, or some other kind of criteria. And typically it's 1 to 2% of the assets under management. And that means they're just taking that fee. And the thing is, that really is more covering the costs for them. It's not really where they make their bread and butter most of the time. Where it really comes in is once an asset performs well and it sells, and generally, as you know, if you have a stock portfolio, when you sell a stock, if you've held it for more than a year, or if you own real estate and you hold it for more than a year, then you actually get preferential tax treatment, because it's a capital gain, a long-term capital gain to be more specific. So this means that your rate is actually lower on that asset. So what these companies do is, when an asset sells and it was funded by these equity investors, typically large pension funds or things like that, then they will take a cut of that profit. For example, maybe they take 20% of the profit. Well, because that was from the result of selling a capital asset, that becomes capital gain to the fund managers, and therefore they're getting preferential tax treatment. So the idea is that, well, they should pay the same tax rate as hardworking Americans and not get this special tax break of capital gains. So backing up a little bit of history, in December 2017, when the Tax Cuts and Jobs Act passed, they did try to close this loophole a little bit. And they expanded it to say, if you have this profits interest or carried interest, where you didn't invest any money, but you are going to receive the benefit of profits, then you must hold that interest for at least 3 years in order to have long-term capital gain. So that cut down potentially on some of that preferential treatment. Of course, a lot of assets may be held longer than that, and they'd still get preferential treatment. We were lucky for real estate that that actually didn't apply for real estate. So typically you have the same structure when you have a syndication, or someone, a general partner or a sponsor, as we like to call them, is raising money. They typically are doing pretty much the same exact thing and taking a cut of the profits. But real estate, you actually don't have to hold for 3 years to get that special preferential treatment. As long as you have a long-term hold over 1 year, you still get that treatment. Of course, that was something that they were going to potentially close the loophole on in the Inflation Reduction Act that was passed recently, but it got taken out at the last minute, luckily for real estate. So let's get into an example so we can show you exactly how this works. All right, we're at the board. So let's go through this quick and easy example. Just know that I'm keeping this really simple. A lot of the numbers are just rounded. Some of the assumptions you may question and say, I don't know if that you'd actually get a loan with that interest. I don't care. This is just to illustrate a point. Let's say you've got a $60 million deal. You're buying a $60 million asset. It's real estate. Let's just say it's an apartment. Doesn't matter. And you decide as the sponsor that you're going to raise $20 million of equity. Okay? So that's your equity capitalization. And then you're going to get a $40 million loan on the property to acquire it. So your total capitalization is the $60 million. Again, keeping it really simple. We're not figuring out reserves. We're not figuring out any of that. We're not going to worry about improvement costs. Super simple. Then we're assuming that you've purchased this property at a 5.5% cap rate. Again, big assumption. Don't look into it too much. That's not the point. So if you have a $60 million purchase at a 5.5% cap rate, that means your NOI, or net operating income, is going to be about $3.3 million. And this is your NOI before debt service, okay? Because your cap rate does not include the debt service. Next, let's assume that as part of this deal, the sponsors agreed that they're going to pay the $20 million equity partner or partners a 5% preferred return, meaning that before the sponsor gets a share in any of the profits, the investors have to be paid a 5% return on their $20 million equity. And then after that 5% preferred return threshold is accomplished, then they will split the proceeds after that 20% and 80%. 20% going to the sponsor, 80% going to the equity investors. So that's the makeup of the deal. So knowing that, we have a $60 million purchase and they've bought it at a 5.5% cap rate. Don't question the cap rate. That's not the important part. We're just trying to illustrate how this carried interest works and why it's important. And this will also, if you're investing in any kind of syndications, a lot of them are structured this way with some kind of variety. So this will help you understand how those deals actually work if that's something that you want to invest in, or if this is something that you're looking at, you've been in real estate and you want to start raising capital, this is a potential way that you could start structuring it if you want it. Essentially, you take your $60 million times your 5.5% cap rate, and you get a $3.3 million net operating income, or NOI. So the NOI is before your debt service, okay? So we have to come up and we have to figure out what's our actual cash return from this investment that we're going to be able to split between the equity partners and the sponsor, who we're going to assume didn't put any capital in this case, for simplicity, okay? So if we assume a mortgage, which is $40 million, and we say that the interest rate is 3.9% and it's amortized over 30 years, again, a lot of assumptions, don't question it, you get to essentially $2.3 million of debt service annually, or about $190,000 a year. This means after you subtract your debt service from your NOI of $3.3 million, that you get $1 million net income, okay? Net income after debt service. That is the amount that now you have to figure out, does it go to your equity members as a return or the sponsor as a carried interest? And really, a carried interest can also be referred to as a profits interest. They're essentially the same thing, just different terms. In order to figure out where this $1 million net income would go, we have to look at the deal. And remember, the deal was that the investors will get a 5% return before the sponsor gets anything. So $20 million of equity times a 5% pref means there's $1 million. And again, I made it really simple. I made the numbers match because when we go further in the example, it just makes it easier when we do this. So that means because we have only earned enough to pay the 5% pref, it's going to all go to the equity members. And this is actually pretty typical in the first few years of acquiring an asset because there's generally not enough to pay the sponsor yet. That's not really when they make most of their income. It's really at the end when they sell the asset. So let's move to that. So now let's assume it's 3 years later and you sell the asset for $70 million, okay? Well, we know that we have to first pay off our debt. And again, I'm keeping it super simple, okay? So we know you'd probably have some debt pay down with your payments every month, unless it was interest only. But we're just going to keep it simple, and we're going to assume your principal balance of the debt was the same as when the asset was acquired. So we're just going to subtract off 40 million of our proceeds has to get paid first. Then we're going to say, okay, we still have 20 million of equity that's sitting in there. We have to pay those people first. So when it's all said and done, we have $10 million left over to figure out where that goes. Again, I'm ignoring any kind of selling costs, things like that, okay? In this example, we've already had 3 years pass. We had $1 million of income each year, which went to satisfy the 5% pref, and we're assuming the $70 million sale happens in that third year also. So if that's the case, we've already satisfied the 5% preferred return that the equity members have to receive first because of the cash flow. So that means now we're at the profit split or the carried interest. So 20%, we said, of the 10 million is going to the sponsor. So the sponsor gets $2 million. They didn't put any money in, but they get $2 million because that's the agreed amount they decided to split. And then the equity members get $8 million. This $10 million gain, because it was an asset, it was real estate, used in a trade or business, it was held for more than 1 year, that $10 million is a capital gain. So when you split the profit, of which is capital, the $2 million the sponsor gets is now capital gain. Even though really what they did was they got that profit because they put the deal together, they managed it, they had the connections, they put the loan together, maybe they guaranteed the loan. All of these pieces, this was part of their business, but because it was a capital asset, they get capital gain treatment. So that is the carried interest, and that's what people are typically upset about, is why is the sponsor getting that preferential treatment?